The next account we want to add, the next feature we want to add to our model is to account for taxes. Right? If this is going to be a legitimate candy selling operation, we need our taxes and we know how to pay Uncle Sam. So to do that, we need to incorporate both a tax expense in our income statement, but also taxes payable in our balance sheet. And the reason is often we don't pay our taxes right away. At least for personal income taxes, some of it's withheld throughout the year, but some of it we pay at the end of the year, kind of the April 15th normal tax filing deadline. All right, so let's see how we incorporate both of these into our model. So first, we're going to go ahead and do the income side. I'm going to make a little bit of room here. We just need we'll actually do 2 more lines here. So we'll move it down by 2. And below interest expense, we're going to layer on EBT. So EBT, earnings before tax. So another subtotal here. EBIT minus our interest. And now we can add our tax expense. Our tax expense is just going to be based on our income before tax. Right? We have our earnings before tax or our income before tax. So we can take that number, multiply it by our tax rate, and that gives us our total tax amount. Our net income can now adjust to take out the taxes. So now we have EBIT minus our tax expense, and we see our net income dropped. Correspondingly, our cash on the balance sheet also dropped. Now what that assumed then is that we paid all those taxes during period 1. Right? That might not always be the case. So first I'm actually going to zoom out just slightly for us. Zoom back in just, right about there. Actually, I'm going to zoom just a little bit more. There we go. We need just a little bit more room. So the reason is I want to incorporate taxes payable. So to do taxes payable, that's often a current liability. So let's make one more line here. So let's slide all this down just a little bit. Give us some room to work with. I'll also fix my formatting. Sometimes you see lines like this get deleted just as you're moving around, so we'll fill that in. We'll also put some formatting up here just to keep things nice and neat. Now what we need to add are our taxes payable. In this case, we're going to assume that all of the taxes are payable at the end of the year. We could add another parameter that would be the percentage of taxes that are payable at the end of the year. For now, we're going to keep it simple and just assume all taxes are payable at the end of the year. So we're going to set this equal to our tax expense of that year, right? So I incurred these taxes over year 1. At the end of year 1, they're still due or they're still payable. So we can put those right there. Now what we need to do now is incorporate that into our current liabilities. Let's add these together. And now we should see that those now add into our assets. And as soon as we made that adjustment, they added into our equity and liabilities, and as soon as that happened, it added into our assets, which also adjusted our cash up. So let's actually rewind that real quick. If we delete our taxes payable, so we assume it's 0, our cash balance goes back down. Right? If we undo that, we see our taxes payable goes up and our cash goes up. Again, they're on opposite sides of the balance sheet. A liability and an equity account went up, so the cash has to go up to balance. Those are going to move in the same direction. All right, so our taxes payable now balances. Essentially, we had no balance sheet impact here, no cash impact, because while the taxes reduced our net income and thereby reduced our retained earnings, they were increased on that liabilities side because our taxes payable went up.